Good morning and welcome to this Monday, August 23rd, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, got another month of options expiration in our rearview mirror. It was kind of a rough week last week, but we did bounce back nicely on Friday, especially on the NASDAQ. Talk about that in just a minute or so. This morning, things not looking too bad. Last time I checked out the futures, we were up pretty nicely. Futures can maybe been 10 or 15 minutes, but futures were up about 175 points. S&P 500 was up about 15. I think the NASDAQ was up maybe 35 or so. So it definitely looked like we are going to get off to a decent start. A little bit of favoritism, I guess, on the Dow this morning on a percentage basis, looking like it was going to move up a little bit more at the open than the others, but we'll see how that progresses throughout the day. But again, starting a new week, options expiration in our rear view mirror. This is a week where the market can struggle a little bit. Historically, we got to get through the 25th, which is Wednesday. We still got some pretty good earnings coming out this week. I mean, obviously things have slowed down quite a bit from where we were just a week or two ago, but there are still some big reports. So if you're not sure when your stocks report or your company's report, you might want to double check, just make sure you're not holding a stock that you don't want to hold into its earnings report. A lot of retailers will be reporting this week and next. So if you're holding any retailers, you may want to double check those. Let's go ahead and take a look a little bit at, well, before we get into the market, let me just take you over to Earnings Beats if you're new. You can go over to earningsbeats.com, and one of the things we do is we have a free newsletter. So we'd love to have you join us. You can go down to this area here where you can subscribe to our free Earnings Beats Digest newsletter. It's published 3 times a week, Mondays, Wednesdays, Fridays. All you have to do is type in your name, email address there, hit the subscribe button, no credit card required. You can unsubscribe at any time. This morning, usually I talk about individual stocks, something about earnings, relative strength, those types of things that we really focus on in Earnings Beats. Today, I actually looked at a group that I think could be starting a bullish run to the upside. And I'm going to talk a little bit about that later in the show, but that's the kind of information that you can get from the newsletter. So highly recommend that you sign up. Again, it's just name and email address. No credit card required. We'll get that out to you. Moving on to the market from last week. We did end, like I said, on a positive note. Many of our indices, all of our key indices anyway, were below the 20-day moving average, and some of them were below the 50-day. If you look over here at the mid caps, small caps, well, we had a big recovery across the board on Friday, and that sent the Dow Jones Industrial Average back just above its 20-day. We'll see whether or not we hold, but at least based on futures this morning, should get off to a decent start. S&P 500 climbed right back above its 20-day, up 36 points, about 0.8%, 44.41. As bad as last week was, and I hesitate to talk about this because the S&P 500 is being driven by a lot of the really heavy large cap names, you know, the Apples and the Microsofts. And it's not really representative to what's going on under the surface in a lot of areas of the market, but still one really good day and the S&P 500 within earshot of another all-time high. The Dow, you know, we went back down below 35,000, but here we come right back up above 35,000. So, you know, 1.5%, we're going to be right back up there again. NASDAQ, this one was more important to me because we were flirting around that 50-day moving average. We still had this prior low from July, which coincided with the top that we saw back at the end of April. So I'm going to say 14,200 thereabouts was pretty big short-term support level. We never really got down there before we reversed on Friday. You can see that the negative divergence that we had, lower PPO, higher price, 2 things I look for when I see that. Number 1 is a 50-day test, and number 2 is the PPO centerline test. So some look at negative divergences and think long-term bearish problems. I don't. I just look at short-term momentum issues. It's a, you know, We went up, we were running out of steam to the upside. A lot of times we get a little pullback, reset, what I call reset of the PPO back at the center line. The analogy I like to use is a baseball game. You know, when you have a baseball series, 2 teams play 3 games. After the first game, one team wins 10-0. You don't come back the second day and start 10-0. You go back the second day and there's a reset. You start over again, 0-0. Who's going to win? No big advantage. That's when when I'm looking at the PPO and I see the PPO back at the center line, I'm thinking the game started over. Momentum is back at 0. It's 0-0. Who's going to take charge? And if you're in an uptrend, I normally expect that we're going to eventually turn back to the upside. And in a secular bull market, that's going to be my default. I'm going to remain very bullish until the market tells me otherwise. Some like to constantly look for reasons why the market's always topping. I'm always looking for reasons why it's going to reverse, go back to the upside when it sells off, because we're in an uptrend. Anyhow, NASDAQ bounced really nicely, up more than 1%, close to 1.2% on Friday, 172 points, and still not that far from the 15,000 level, which would be an all-time high. So NASDAQ still looks fine. Mid caps and small caps, they definitely have been beaten up a little bit worse. Of the two, I like the mid caps mostly because the AD line's stronger. I think price action is stronger, which is reflected by the 20-day still above the 50-day. On the small caps, you can see we had that death cross about 6 weeks ago, the 20 going below the 50. Mid caps did that, but came back above. And you can see the NASDAQ, S&P, and Dow are all consistently that 20 days been above the 50. So I'm looking at all the major indices. I'm still fine with them. Mid caps, small caps, no doubt under a little bit more relative pressure, but overall, everything still seems to me to be an uptrend. Looking at the sectors, technology making another breakout on Friday. So yes, we were weak earlier last week, but we came roaring back on Thursday with a big reversal, and then Friday went higher, which was good. But, again, that's led by Apple and Microsoft. So we have to kind of take it with a grain of salt there. Utilities continue to moving higher. Long-term relative weakness in utilities. There's long-term relative weakness. So when it was going down, I kept talking about, okay, we're in a secular bull market. We're likely to get rebounds from every group. I think every group will go higher in a secular bull market. Materials and energy, a little bit different, because if the dollar strengthens considerably, I believe those two areas could potentially go down on an absolute basis, but on a relative basis, definitely I wouldn't be interested in them. Utilities look great right now for the last 2 months. In fact, I'll come back to this in 1 second. Discretionary stocks reached a key area at 175 and held, bounced nicely. I'd like to see this group get back up through the moving averages. This is a group I would expect to do well from here, because I don't think anything's breaking down. So I would be careful to draw too many conclusions from a pullback to the 175 level. But a break below 175 would be a little surprising to me and would likely lead to more weakness short-term in discretionary stocks. We'd probably be looking down more toward the 170, maybe even 165, if things were to really begin to crank up on the sell side. In September. We do know September is not a great month. I don't expect there's going to be a lot of selling right now. I'm open to the possibility, just because I know that this time of the year can be a little daunting. But the market's been extremely resilient. Revenues, earnings came in very strong this last quarter. 10-year Treasury yield still very low. I just don't see a lot out there to take the market down, but I could be wrong. Like I said, September, we tend to get lots of stories to drive the market lower. We'll see. NVIDIA and Deere from Friday. NVIDIA was the best performer on the S&P 500. I think Deere was the second or third worst performer on the S&P 500. NVIDIA had come out with its earnings on Thursday. You can see that huge move up. Well, actually a lot of volatility, but then the move up came on Friday. That was actually an all-time high close on NVIDIA on Friday. On Friday. So we're good there. Deere, however, came in with a good number, gapped up early, but then continued to sell off. And remember, Deere went through this huge run to the upside for an extended period of time. I think it's just sideways consolidating. Think about Amazon. Everyone looks at Amazon and says, what's wrong with it, with Amazon? It's just not going anywhere. Market's been going up. Amazon's going nowhere. A year ago, Amazon was 1,500. It went to 3,500. It needs time to consolidate. Every stock needs time to consolidate. I think that's what we're going through right now with Deere. I think Deere just got some issues it's going to have to work through for a while because the stock went up so much. It's just going to take a little while for the fundamentals to catch up with the technicals. So let's go back. I want to talk about the utilities here for a second. So utilities look great for 2 months here, right? So we pull utilities up. I'm going to go over here to the relative strength of sectors, and I'm going to pull up utilities. And I just want you to see, because on a short-term chart, they look really good. Here is your long-term relative strength on utilities. So down here is your absolute chart. We broke out above that February 2020 high. So that's definitely encouraging more folks to buy utilities, but don't expect the recent leadership to last in utilities. This is a relative strength chart. Yes, we go through periods where we'll see some pretty nice relative strength, but they tend to not last very long. And once they're over, you don't want to be in utilities. Utilities just kind of fall back. You'll probably see utilities at some point moving back down that 66, 67 range, and then pick back up again. But if the market's doing well, I expect what you're going to see is this relative strength. Maybe by the time we get up to about the relative, this 50-week relative moving average, I think once we get up there, I'd probably be looking for another turn to the downside. All right, moving on to the 10-year Treasury yield. Economic reports out today. We have August PMI composite due out later this morning. 59.5 is the estimate. July was 59.7. So we're looking for a slight tick down there. And then July existing home sales also out later this morning. The expectation there is 5.83 million units. June was 5.86. So a little bit of a tick down in existing home sales as well. All right, moving on. I wanted first just to point out an article that I wrote, because I do think this is kind of a big deal, especially if you like to trade energy and materials. I've been saying for a while, I'm not big fans of those groups. Even when materials were leading on a relative basis, I said, just be careful with them and watch the dollar, because the dollar to me was showing signs, or the signals I was getting was that the dollar was going to go higher. And yet we weren't seeing a breakout in the dollar until last week. So on Thursday, you can see this breakout above the late March high on the dollar index. That set the highest level the dollar has seen in 2021. So we're now at a 2021 high, although we did reverse a little bit on Friday. So what does this mean? Well, a couple of things. First, I want to just point out on this chart, you see all these black arrows? These are, you can see the RSI going down to 30, even below 30. Or here we got up to 65, there's 70, a little over 70, back down below 35, and then back up above 70. When you're going from 30 to 70 on any chart, doesn't have to be the dollar, it can be an industry group, weekly chart, daily chart, it could be an individual stock, it could be a cryptocurrency, it doesn't matter. Anything that you're looking for a trend. When you're seeing RSI go above 60, up near 70 or above 70, and then it goes all the way back down to 30, and then it goes all the way back up to 70, and then it goes all the way back down to 30. When you're in that 30 to 70 range, that is indicative of a trendless market. If you're not trending, chances are you're going to see these 30 and 70 prints. When you're trending down, you tend to stop at 60 and you tend to see oversold below 30. When you're trending up, you tend to see moves up, RSI topping out 70 or above, and then the RSI coming down touching 40, which is what it did in February. But then once it comes back down below 40, it kind of throws that whole uptrend out of whack again. So here, what we've got recently was a 40 test, that green arrow. I just wanted to point out 40 test and a breakout. Now that combination to me suggests we're probably in an uptrend. And that confirms what I've been talking about. This is the chart that I like to follow in terms of trying to get clue on the dollar. And the reason it's so important to have a clue on the dollar is it gives you a leg up in trying to figure out whether you want to be in energy and materials. And I'll explain that in just a minute. But if you're looking at this, you can see this top panel. I think it's pretty clear we've been moving higher. This is the difference, not the relative strength, not the price relative. This is the difference, simply subtracting the German Treasury yield from the US Treasury yield, 10-year Treasury yield. So the difference in the US versus Germany. So when it's going up, it means our 10-year Treasury yield is outperforming Germany's 10-year Treasury yield. Now, Economics 101 taught me that bond yields go up when the economic environment improves or is expected to improve, or when there's a big inflationary threat. Well, we didn't have any inflation through these 10 years. So I think it's pretty safe to say that over the last decade or even more, the US economy has been stronger than Germany's. And as a result, yields have been going up. Well, that impact, the difference in the yields rising, also sends the dollar higher. And you don't have to believe me. Look at the correlation. So if you put it on correlation, which is a pretty cool tool at stock charts, you can compare any two, stocks, industry groups, or in this case, this difference. Any two values you can compare for correlation. Are they positively correlated? Are they inversely or negatively correlated? Well, this is the difference in the yields. That's the first thing I'm looking at. And the US dollar index is the second thing. Look at where it resides almost all the time, positive territory. So you can argue and say, well, this doesn't, I don't believe that should work that way. But okay, well, we've just been lucky for 15 years because almost always it's positive. And what I've been pointing out is that when it does go really significantly negative, it tends to suggest that we're about to see a major move in the dollar. Here, the inverse correlation, I'm not going to go through all these. I've done this plenty of times. I don't want to spend too much time on it. But that inverse correlation was the 10-year Treasury yield in the US moving higher, faster versus Germany, and the dollar was going down. So we had an inverse correlation. So what happened? The dollar came roaring back. And if you look at all of these green shaded arrows or areas, the green shaded areas, that they all coincided with the yields going higher in the US versus Germany, but the dollar going lower. And in each instance, the dollar came flying back. Well, recently we have seen the yields in the US going higher. Overall, we've been going lower. We're starting to come back in the dollar. And that's why I think that breakout in the dollar is pretty important, because what I'm expecting is for the dollar to follow suit in what we've been seeing in the Treasury yields. So all of this makes sense to me. We're getting this breakout. It's starting to look like an uptrend. And that's what this chart's been telling me for a while. So then it takes me on to energy and materials. So this is a 20-year chart up here of the dollar. And you can see 2002 to 2008 dollar very weak. During that period, energy and materials relative to the S&P 500 were very strong. They led the bull market from 2002 to 2007. Energy and materials, big moves to the upside and relative strength. Dollar got choppy, relative strength got choppy. Dollar strengthened. Look at energy and materials on a relative basis. Now, I know materials just had a pretty good run, but if you look at this chart and you look at the lower low, lower high, lower low, lower high, lower low, this top was still a lower high. We're still in this downtrend. The dollar, in my opinion, is still in this uptrend. I think it changes if the dollar index goes below 88. Until the dollar index goes below 88, I personally would be very careful. Now, maybe what we're going to do is chop. Maybe we'll do a chop, kind of like we did back 2008, 2011. If we chop, then we'll probably see energy and materials chop on a relative basis. But I would not write this uptrend off until we see that breakdown below 88. All right. Anyway, I wrote this article. If you don't follow me over at Stock Charts, I mean, I try to not just say, hey, I think the stock's going up, but a lot of times I try to give reasoning why and the intermarket relationships that you should be focusing on. But if you want, go over to Trading Places with Tom Bowley, check out the articles. If you like the articles, you can always go back in the archives. So once you go in, you can go back and you look at prior articles, pull them up. And if you like the style and you're reading one of the articles, scroll down, and below my sign off, there'll be this box down here, and you can subscribe to my blog. Completely free. All you're doing is typing in an email address. And what will happen is when I write my article, I used to always write my articles before I came back to Earnings Beats as chief market strategist. I was senior technical analyst over at Stock Charts, and I wrote a blog and I published it every morning, Monday through Friday at 9 a.m. Maybe a couple minutes off from time to time, but just about every morning I published exactly at 9 a.m. So you didn't really need to subscribe because you knew at 9 a.m. you could go in here and find my article. Well, I don't do that anymore. And now I just kind of publish an article when I have time, when I have a topic that I want to talk about. And so now it can be anytime. So I just wrote yesterday, published on a Sunday at 12:14. I don't know when I'm going to publish, but if you sign up and subscribe to the blog down here, as soon as the article is published, it'll be sent to your email. So it's a nice feature that Stock Charts provides. You should take advantage of it. So just make sure you got that email address entered in there, and then we'll make sure, or Stock Charts will make sure that you get the articles going forward. So I spent a lot of time on that article because I've had feedback in the past. Why don't I like energy? Why don't I like materials? Why aren't they in our portfolios this quarter? Well, there you have it. There's the explanation. Just not a big fan. And the signals are telling me the dollar is going to go higher. And if I believe the dollar is going higher, that chart I just showed you, energy and materials don't do well. I don't want a group that's underperforming the S&P 500. Trying to find an individual stock that outperforms the S&P 500 when its entire sector is going down relative to the S&P 500 is difficult. Makes it hard. All right, so I wrote this article, two groups I didn't like. And I went in and even after I go down below this energy and materials, I pointed out that steel, which have been just absolutely on fire for the past 15 months, and aluminum. These are the two best areas of materials, but both of them have negative divergences on their weekly charts. And aluminum in particular failed to hold the breakout level with a negative divergence. I find that even more bearish. So I'd be real careful with these two. If both of them can get back up and break out to new highs, and the weekly PPO can somehow work its way back up, to a new high, that eliminates the negative divergence. But I think best case scenario for both of these groups is that they muddle along to the upside. And I think worst case is that last week's selling, which was 7.6% on steel and 16% on aluminum, that selling continues, that type of selling. We could see a very quick trip down to the 50-week moving average. So that would be the worst case for me. Anyhow, the reason I mentioned that is one group that I wrote about in the digest this morning that I really like is the railroad group. So transports have been, taking a back seat. That's been one area of the market that has concerned me. Transports have not been doing well. But what I want to also, and I'm going to come back to this chart, but I want to just show you, if we look at the transports on a seasonal basis, and we go back just over the last 9 years is the secular bull market from 2013 to 2021. But look at transportation stocks in September and in November. September, they average going up 2.2% during the secular bull market. November, 5.9%. And October in between is a little bit more of a neutral month. But if you compare these 3 months, it's by far the best 3 months to be in transports. So just keep that seasonality in mind when you look at what's happening here on the railroads, because I see a break of this little wedge coming off the uptrend. So we had this uptrend followed by this downtrend. So if we just connect those highs and then drag that down, well, guess what? That connects almost perfectly with these lows. So see how I did that? Connect the highs, drag it down to connect the lows, and we got a channel. Well, we broke out of it. We just broke out of the channel. Look at the 20-day coming up above the 50. We've pulled back over the last 5 or 6 days, I think, giving potential entry into the railroads on this 20-day test. But I'm looking for this group to turn back up. We're getting ready to head into September. Railroads like the September through November period, just like overall transports do. AD line started to turn back up again. That was a pretty big move, one of the bigger moves, not really immediately going back down like it did before. So I think the transports in general look good, but especially the railroads. So just wanted to point that out. So let's take a look at the railroads here. And over the last 9 years, railroads have gone up every year in September, every year in November. Now they've gone up. Now, if we look at them relative to the S&P 500, September, they've outperformed the S&P 500 every year since 2013. I don't know how far that goes back. Well, that's it. 2013 is when the streak began. Now, the underperformance in October has been pretty significant, but then we come roaring back again in November. Overall, these 3 months are the strongest 3 months on a relative basis versus the S&P 500 versus any 3-month period in the year. So railroads, I definitely think, deserve your attention. And that September period for sure. If we get a big run, maybe keep in mind what could be coming in October, but September and November, both very strong. All right, some questions that came up from our event last week. So I thought I'd just go through those. There was a question about Tesla. I guess what I thought of Tesla. I still like Tesla. I own some of Tesla. Just kind of holding it. I think it broke out of this triangle. If you connect those highs and then you connect the lows coming up here, I think we broke out of the triangle, came back down, testing the triangle, and I'm looking for Tesla to move back up again. So I'm still a fan. Another question had come in on ASML. ASML, nice move up, pull back. AD line looks good. And maybe the question was why wasn't it in our portfolios? I just simply like the other semiconductors better. There were a lot of semiconductors that I was looking at. I think ASML was on the list. I just eventually ended up going with others. There are a lot of really nice looking semiconductor charts of ASML or your other semiconductor that you happen to like. If they weren't picked, it probably wasn't because they didn't look good. It's just that there's so many to pick from. And one other question that came in our webinar, our portfolio draft the other night, was what's the difference between UA, which is Under Armour, and UAA, which is Under Armour? And they both look like the same chart. There's UAA. Right now it's 2345, and UA is 1974. So what's the difference? Well, the difference technically, well, fundamentally, is UAA is their Class A shares, which has voting rights. UA is the Class C shares, and they do not have voting rights. So you're paying a premium for UAA because they have voting rights. But on a relative, I mean, if you look at the charts, they're very similar. I don't know that your performance is going to be that much different. So I guess it comes down to the question, do you want to have voting rights? If you don't care, you're just trading it short term, you're not going to vote anyway. It doesn't matter which one you own. You should get roughly the same performance. There's still ownership in Under Armour. So hopefully that helps to explain that. All right, earnings spotlight. Got a few companies. Well, JD reported this morning, and the market's going to open here in 10 seconds. But I'll just show you JD on the chart. been going down. It's been going down with a lot of stocks that are in China. Many of them have been hit hard this year. This one put in a double bottom. They did beat earnings earlier, 45 cents versus 41 cents. Let's see if it's got a price now. It was up pre-market a couple percent. Yeah, it's up 2.94%. This, other than the short-term trade off of double bottom, and probably, I didn't look at options, but I'm sure probably options could have an impact here. You might get the 20-day, maybe even up to the 50-day in the near term, but I'd still honor this downtrend here until it breaks back to the upside. Other companies that will be reporting later this week. Later today, we've got Palo Alto Networks. So let me just show you that chart, and then I'll just tell you some of the others. Palo Alto Networks, you can see, I see a little bit of a cup and handle, or maybe an equal high and a rising low. So maybe an ascending triangle. The stock hasn't been doing much, though, in terms of accumulation over the past 7-8 months. On a relative basis, the stock is down near this double bottom. So it's definitely got some mixed signals. I like the pattern, though. So if they do come out with earnings and they beat and they break out, I think you could see that relative strength pick up in a hurry. So I'd just be watching that 400, 403, 404 level, whatever it is, recent highs. See what happens there. Now, as far as upcoming earnings, I'm just going to read some of these out to you. Tuesday, we got Medtronics, MDT, Intuit, big software company, INTU. One of the companies I mentioned last week in Max Payne, Pinduoduo, PDD, they report Tuesday. Best Buy reports. And then Nordstrom's, Toll Brothers report on Tuesday. Wednesday, Salesforce.com, Snowflake, and I'm about to show you a Snowflake chart on the 3 you must see here in 1 second. Autodesk, Splunk, Alta, Network Appliance, Elastic, ESTC. Williams-Sonoma had a big report last quarter, WSM. We'll see what happens there. Anyhow, still a lot of reports, as I mentioned, coming out later this week. All right, let's move on to the 3 you must see. I'm going to start off with Snowflake. Sold off on really big volume. Looked like it was breaking below the 50-day, but it came back up and held it. I would be watching 2 things. Number one, I'd like to see it continue to trade above the 50-day, close above the 50-day. If it doesn't, I would just be really careful if that recent low goes 247, because buyers stepped back in on very heavy volume. That should be excellent support going forward. To the upside, what you want to see is a break back up above the recent high. So around that 290, 295 area. If we can rally off of that reversal on Friday and break back up above 300, that would be incredibly bullish here for Snowflake, because I believe that would represent a lot of accumulation. And you can see the AD line's been soaring. It went up to a 52-week high, even though price is still way below the 52-week high. So that candle from Friday reeks of accumulation to me. 2 more, KTB. This is Contour. And I think this is clothing and accessories. Yes, it is. This was a stock that was looking really good back in May, but it has been struggling. Broke down on Friday, closed below these prior lows. I'd be careful on this stock on any 20-day test, because it's starting to look like maybe a downtrend, and that close at a new low on Friday tells me any kind of a bounce, respect that 20-day EMA. And then finally, Buckle, BKE. So Buckle had a big move down, but it held. Look at that. It looked like it was breaking down on Friday, but it came back up and it came back up and held above that prior low. So it didn't fail like Contour, KTB. Instead, it held support, and it's up a little bit this morning. So I think this one is still sideways consolidating. Now, if we go back down, I think that level is a kind of big level short term. I think the bigger one's this one over here, because this is the higher high, higher low, higher high, higher low, higher high. Don't want to lose these lows. So I think on Buckle, for me, it's down around 38, 39. That's the level I'd be watching. All right, let's see what the market's doing here. We're about 4 minutes in. See if we're holding on to our gains. Yeah, Dow Jones up 200 this morning. S&P 22, NASDAQ 75. So all up above 0.5%. Mid caps, 0.8%, small caps, almost 1% higher. You can see that VIX pulling back. This market is so resilient. I thought last week, maybe as we were starting to sell off, option expiration week, got to get through the 25th, maybe we were going to go right, move back down, maybe to some recent lows, but that has not been the case. And as I was writing in my article, it's hard to bet against the stock market. It's hard to be constantly bearish when the market is constantly bullish. I mean, that'll just drive you crazy. And then all you want when you're constantly bearish is to be proven correct. I actually took it was this kind of a psychological course on money and the impact it has on you emotionally. I did this probably 15, 16 years ago, and it was really enlightening how most of us cannot accept being wrong. If we think the market's topping and it keeps going higher, we want to short more. We want to be proven correct. And you've got to be careful with the market, because the market, especially in a secular bull market, it doesn't care about your feelings. It doesn't care about your emotions. It just goes higher. And sometimes on light volume, sometimes with a negative divergence. And you're always seeing something that says, oh, it can't keep going up. It can't keep going up. And then it just keeps going up. I would just, offer a warning to anyone who is constantly looking for the stock market to go down. When we're in a secular bull market, I literally almost constantly am looking for it to go up. And I know some people think I'm, ultra bullish, perma bull. I don't think that at all. I just know the way a secular bull market works. And when you get into an environment like this, especially coming out of that pandemic, the market hasn't yet reached its valuation where it's supposed to go. We'll know when it does, because at that point we'll have a pretty big correction. I think that may occur next year, as I've said before, but I'll keep looking at that. Anyhow, let's go ahead and wrap this thing up. Appreciate everybody coming in. Next show will be tomorrow over at Stock Charts TV. So if you come to the Stock Charts, right up here, Stock Charts TV, it will air at 9 a.m. I'm still doing recorded shows on Tuesdays and Thursdays because of the COVID variant. Stock Charts office, they don't have those fully opened at this point. So we're still doing a lot of remote stuff. But eventually I'll go back to doing live shows on Tuesdays and Thursdays. But for now, they're recorded, but they are always aired at 9 a.m. Eastern on Stock Charts TV. So right before the market opens, check that out. Everybody have a great day and take care. Happy trading.